The check was already on the table when the owner stood up, not metaphorically, literally there, in a cream envelope beside the defense file, with the bank seal still visible under the courtroom lights. Monday morning, 9:12 a.m., Maricopa County Superior Court. The air conditioner was humming too hard. The gallery was packed with employees in warehouse jackets and work boots, and Daniel Mercer sat at the defense table in a navy suit that fit him like he still believed this was a business meeting he could negotiate his way out of. His lawyer had just said the line they were counting on. My client returned the full amount, every dollar. You could feel the room shift, because in cases like this, that sentence is supposed to soften things. It suggests remorse. It suggests correction. It suggests that the worst part is over. Then Lena Alvarez rose from the second row, one hand on the polished bench in front of her, and said very calmly, "No, Your Honor, he returned money. He did not return what he took." Daniel didn't look at her. He looked at the judge. That told you everything, because by the time that hearing began, everyone in that room already knew this was no longer about a missing sum on a ledger. It was about a lie that had spread through an entire company, through payroll, through safety decisions, through a pending multi-million-dollar sale, and through the lives of people who had trusted the wrong man with numbers nobody else had the time to watch. On paper, it started as simple embezzlement. One employee, one small industrial supply company, one controller moving money where it didn't belong. The kind of case people think they understand in a sentence. They didn't understand this one, because what Daniel Mercer returned was the exact amount investigators could prove he siphoned out of Mesa West Industrial Supply between November 2022 and March 2024, $487,320, not a dollar more, not a dollar less. He wired it back after he got caught, fast enough to make it look almost surgical. He thought he was restoring a balance. What he didn't understand was that Lena Alvarez, the owner he expected to settle quietly, had decided to do something almost nobody does when a stolen amount comes home. She opened everything, not just the theft, everything. She turned over her own books, froze her own acquisition deal, invited forensic accountants into her own company, and told state investigators to pull every invoice, every vendor file, every internal email, every access log, every deleted spreadsheet. She risked the reputation of the business her late husband built over 31 years, because, as she later said under oath, if the numbers were false, then every decision made from those numbers was poisoned. That was the moment this story stopped being about restitution and started becoming about consequence. And if you appreciate stories where power finally meets consequences, stay with me, because what happened next destroyed the one argument Daniel thought could save him. Mesa West sat off Buckeye Road in Phoenix, in a beige warehouse nobody outside the trade world would ever look at twice. They supplied valves, ducting, fasteners, electrical housings, and specialized components to commercial contractors across Arizona and New Mexico. Nothing glamorous, everything essential. By 2023, the company employed 46 people and cleared just over $11 million in annual revenue. Lena Alvarez was 62, widowed, disciplined, and known for walking the floor before sunrise in steel-toe boots, not because she had to, but because she believed owners who stopped seeing the warehouse eventually stopped seeing the truth. Daniel Mercer was 37, credentialed, polished, and exactly the kind of employee small companies are taught to feel lucky to land. MBA from Arizona State. Previous roles in regional logistics. Soft voice, expensive watch. He knew how to say cash flow optimization and margin discipline in a way that made ordinary decisions sound strategic. He joined Mesa West in 2021 as controller, and within 6 months he had become the person everyone relied on to explain why the numbers looked tight, while the company appeared more profitable than ever. That contradiction should have bothered more people earlier. Margins were up, Daniel said, but liquidity was strained. Receivables were improving, but over time needed to be cut. The company was right-sizing expenses, which sounded reasonable until you translated it into human terms. Weekend shifts disappeared. 2 warehouse replacements were delayed. A forklift maintenance contract was pushed back. A dock camera system Lena had approved was postponed 3 quarters in a row. Employees were told to be patient because a sale was coming. That sale mattered. In late 2023, a private buyer called Stonebridge Operations Group had entered due diligence to acquire Mesa West for $18.4 million. For Lena, it was an exit plan. For the employees, it meant retention bonuses and, if the deal closed cleanly, severance protection for older staff. For Daniel, according to what investigators would later prove, it was a clock. The first crack in his story came from something embarrassingly small, an invoice for $460 from a vendor called Redcliffe Safety Solutions had been marked paid in January 2024, but the warehouse never received the ordered dock restraints. When the operations manager, a blunt 20-year veteran named Jose Mendez, asked where the equipment was, Daniel blamed a back order. Jose made a call himself. Redcliffe said they had never invoiced Mesa West for that amount. In fact, they had never done business with the company at all. It should have ended there. An internal review, a firing, maybe a civil agreement, quiet damage control. But Daniel made the mistake arrogant people always make when they've been getting away with something for too long. He assumed the person across from him still needed him more than the truth. On March 14, 2024, at 6:40 in the morning, Lena asked him into the conference room. She had the fake invoice, the ACH history, and 2 vendor records that didn't survive basic scrutiny. Daniel looked at the paper, leaned back, and said the problem was a temporary commingling error during a software migration. He used that phrase twice. Temporary commingling. As if language could reduce theft to friction. Then Lena asked him why one of the vendor bank accounts traced back to a Chase business account opened by a company called DM Operational Consulting LLC, with mailing records tied to a UPS store box 3 miles from Daniel's apartment. That was when he stopped explaining. By 2:17 that afternoon, the money was back. Not some of it, all of it. A single wire transfer for $487,320 into Mesa West's operating account. According to later testimony, Daniel followed it with a private message to Lena, asking for a meeting to resolve this professionally. What he meant was obvious. No police, no complaint, no public filing, no audit that widened beyond the amount now restored. Most owners in that position would have taken a breath, taken the money, taken the win, and tried to bury the embarrassment. They would have told themselves that protecting the company meant containing the scandal. Lena Alvarez did the opposite. At 4:03 p.m. the same day, she hired a forensic accounting firm out of Scottsdale. At 5:11 p.m., her counsel notified Stonebridge that due diligence was suspended pending an internal fraud review. At 6:20 p.m., Mesa West issued preservation notices on all company devices, server backups, print logs, access badges, and accounting records dating back to 2021. The next morning, she voluntarily disclosed the suspected fraud to the company's lender, its workers' compensation carrier, and state investigators. That decision stunned everyone around her, including people on her own side. Her attorney warned that a full disclosure could crater the sale, trigger covenant issues, expose tax discrepancies, and invite regulatory scrutiny beyond Daniel's conduct. Lena listened, thanked him, and said a line that would later circulate through the case file like a blade. If I protect the deal by hiding the fraud, then I become part of the fraud. That was the unbelievable thing. Not mercy, not vengeance. Integrity at a price most people would never pay. And once she opened that door, the story got darker fast. The forensic team found that Daniel's shell vendors were only the outer layer. Over 16 months, he had created or manipulated 5 entities: DM Operational Consulting, Sonterra Freight Audits, Cobalt Field Services, Desert Ridge Procurement, and 1 inactive LLC registered under his brother-in-law's address. Payments were split beneath internal approval thresholds. Descriptions were copied from legitimate vendor invoices. Some entries were disguised as rush freight, inventory variance reconciliation, or safety compliance consulting. He knew exactly which categories drew the least attention because he controlled the monthly close process. Then investigators found the payroll distortion. Daniel had not only stolen money, he had hidden the theft by squeezing legitimate expenses so the books would still produce the margins he had promised. That meant reducing overtime authorizations, delaying equipment maintenance, and misclassifying accrued liabilities to make the company look healthier during acquisition talks. The fake profitability wasn't just cosmetic. It changed real decisions. Tasha Reed, a shipping coordinator and single mother of two, lost nearly 5 months of weekend overtime during the period Daniel was moving money through shell accounts. Carl Benton, a 54-year-old driver with a damaged knee, had his route assistance request denied because cost controls were in place. The dock restraint system Jose kept asking for was delayed while fraudulent vendor payments cleared. In August 2023, a load shift incident at Bay 3 sent a stack of boxed housings crashing from a pallet. No one died. One worker needed surgery on his wrist. That should have been the end of Daniel's defense. It wasn't. He pivoted, first to confusion, then to minimization, then to the argument people use when they've run out of cleaner ones. It was a loan. That was the language his defense team settled on once the criminal referral became real. An unauthorized borrowing, temporary use. No permanent deprivation because the full amount had been returned. In one pretrial filing, they described it as a serious but rectified lapse in judgment driven by personal financial stress. It was the kind of sentence built to reduce a sustained scheme to a bad month. The problem was proof. And then investigators found the detail that changed everything. Buried in a recovered archive from Daniel's company laptop was an Excel file deleted 3 days before the March confrontation. Its title was bland enough to avoid attention, Q4 Cleanup V7. Inside were 7 tabs: vendor loop, carry gap, bonus cover, sale window, and the one that ended the loan argument forever, if forced. That tab laid out 3 contingency options in plain language. One involved backfilling company funds before close, using proceeds from the expected Stonebridge retention package. Another described moving money from a home equity line to restore balance if owner reviews ACH. The third was a blunt calculation of exactly how much would need to be returned to neutralize criminal optics. Neutralize criminal optics, not repay a mistake, not correct an accounting error. Neutralize criminal optics. In the margin of the sheet, next to a figure that matched the later wire transfer to the dollar, Daniel had typed, "Once principal is restored, narrative becomes employment dispute." That single sentence reclassified the entire case from desperation to design. It meant he had planned the repayment in advance as part of the concealment strategy. It meant the return money was not evidence of innocence. It was evidence of foresight. When prosecutors put that document on the screen at the August 2025 evidentiary hearing, the courtroom changed. You could feel it. Up to that point, there were still people in the gallery who thought Daniel had done something wrong, but maybe not monstrous, maybe greedy, maybe stupid, maybe salvageable. Then the spreadsheet went up. The state walked the judge through each tab: dates, transfer amounts, vendor aliases, cross-references to internal close calendars, notes about maintaining EBITDA optics before due diligence meetings with Stonebridge, even a line tracking how long certain vendors could be ghosted before operations noticed. This was not a man covering bills and planning to make it right. This was a man engineering a controlled lie around other people's livelihoods. If you believe no spreadsheet should outrank a human life, subscribe, because the next exchange was the one Daniel never recovered from. Prosecutor Elise Navarro asked him whether the phrase "neutralize criminal optics" referred to preserving the company. He said no. Did it refer to preserving employees' jobs? No. Did it refer to restoring trust? He paused, then said he had been trying to avoid unnecessary escalation. Navarro stepped back from the lectern, held up the printed exhibit and asked, "Mr. Mercer, isn't it true that you returned the money only after the owner found the shell accounts, and only because you had already calculated that repayment might help you avoid prison?" For the first time in the case, Daniel didn't answer immediately. The judge told him to answer the question, and Daniel said quietly, "I was trying to fix it." That was the moment the room turned on him, because everybody there understood the difference between fixing harm and preserving yourself from the consequences of causing it. Lena's testimony made that difference impossible to escape. She didn't perform outrage, she didn't cry on cue. She simply described the cost of decisions made from false numbers. The overtime she cut because Daniel told her cash was tightening, the maintenance she delayed, the acquisition process she halted at the edge of retirement because she refused to sell poison books, the night she spent calling employees one by one to tell them why investigators would be asking questions. At one point, Daniel's attorney suggested that because the principal had been returned, Mesa West had been made financially whole. Lena looked straight ahead and said, "You can restore a balance sheet. You cannot backdate safety. You cannot refund trust after you spend it." There was nothing dramatic about the way she said it. That was why it hit so hard. By the time the grand jury indictment landed, the charges went well beyond basic theft. Fraudulent schemes and artifices, theft by control, computer tampering, falsification of business records, wire-related fraud counts built around electronic transfers and vendor routing. The state licensing board suspended Daniel's accounting authority pending outcome. Stonebridge walked from the acquisition. For a few brutal months, it looked like Lena's honesty might sink the company. Then something almost nobody expected happened. The lender that had initially frozen Mesa West's expansion line reversed course after reviewing the forensic package and Lena's voluntary disclosure timeline. In internal correspondence later cited at sentencing, the bank described her conduct as extraordinary evidence of governance integrity under stress. A revised credit extension came through, not because the company was untouched, but because the owner had chosen exposure over concealment while it still mattered. That decision saved the business. And then Lena did one more thing Daniel absolutely never saw coming. She refused to keep his returned money, not for herself, not as a quiet repair, not as a symbolic victory. Mesa West placed the full $487,320 into a restricted internal recovery fund overseen by outside counsel and an independent advisor. From that fund came employee back pay adjustments tied to overtime cuts directly connected to Daniel's manipulated cost controls, coverage of out-of-pocket costs for the worker injured at Bay 3, delayed maintenance remediation, and retention distributions for staff who stayed through the audit collapse that followed. In other words, the money went where the damage had actually landed. That choice destroyed the final piece of Daniel's posture. He wanted the narrative of repayment. He wanted the visual of the owner taking the money back and moving on. He wanted arithmetic to look like absolution. Instead, the money became evidence that the theft had touched people he never bothered to count. By January 2026, when sentencing began, even his own mitigation witnesses sounded tired. His father talked about shame. His attorney talked about pressure, burnout, the fear of professional failure. All of it may have been true. None of it changed the file. Judge Miriam Sloan reviewed the timeline for nearly 20 minutes before she imposed sentence. She noted the duration of the scheme, the deliberate use of shell entities, the manipulation of corporate reporting during acquisition, the pre-planned repayment strategy, and the downstream human harm. Then she addressed the argument that he had returned every dollar. "Restitution is not immunity," she said. "The repayment here does not erase intent. It confirms awareness." Daniel Mercer was sentenced to state prison, followed by supervised release, financial monitoring, and a prohibition on serving in fiduciary control roles without court approval. Assets acquired during the scheme were seized or liquidated. Civil restrictions followed. His professional standing was done. His name, once attached to clean quarterly reports and boardroom confidence, became a case citation people in compliance circles used as a warning. But the part people remembered most was not the sentence. It was what happened after. As the courtroom emptied, Lena Alvarez remained seated for a moment with her hands folded in her lap. No smile, no performance, no victory pose. Employees stopped to touch her shoulder on the way out. Jose nodded once. Tasha hugged her. Carl, moving slower now, waited until the room had nearly cleared before thanking her for not burying it. That is the detail that lasts. Not that Daniel was clever, not that he repaid the money, not even that he went to prison. What lasts is that when the easiest path was silence, the owner chose exposure. When the money came back, she refused to let it become a transaction that erased the story. She followed the damage all the way to the people who carried it, and then she made the record tell the truth. If cases like this make you think, let me know in the comments, because the real lesson here has nothing to do with accounting software or shell invoices or courtroom language. It is simpler than that and harsher. A lot of people think justice begins when money is returned. It doesn't. Money is the easiest part to move. Numbers obey. Ledgers can be cleaned. Bank balances can be restored before lunch if the person responsible is scared enough. But trust is slower. Pain is slower. The ripple from one selfish decision keeps moving long after the account stops showing red. Daniel Mercer believed he could steal with precision, repay with timing, and escape through presentation. He believed consequence was negotiable if the spreadsheet closed neatly enough. He was wrong, because in the end, the most devastating thing Lena Alvarez did was not scream at him, bankrupt him, or humiliate him for sport. It was worse. She told the whole truth, even when it cost her, and that is why the check on the table never saved him. It just sat there under the courtroom lights, mute and useless, like a final receipt for a lie too expensive to hide.